What's going on, guys? My name is Nick, and if you're new to my channel, welcome to Investing Engineered. So the topic of today's video is how to build your credit score, also known as your FICO score. And I've chosen to speak about this topic today because so many people don't realize how important their credit score really is. Even if you don't ever plan on getting a loan in the future for your home, your credit score still matters. In fact, many landlords will actually pre-screen their tenants in advance by checking their credit score, because it allows them to find out in advance if the tenant is actually reliable and is more likely to make those monthly rental payments every single month. Now, the same thing goes for any lender, like a bank or a brokerage company. They'll all use your credit score to be able to find out what your lending history is like. Having a great credit score can actually impact the interest rates that you pay on a loan. For example, if you're getting out a car loan, you're going to pay a lot less than people with bad credit. Furthermore, I often find that people are consistently making mistakes that actually negatively impact their credit score, but the sad part is they actually don't even know that they're doing anything wrong. This is because your credit score is actually broken down into 5 different key areas that I'm about to discuss in this video. And it makes sense that a lot of people wouldn't actually know how to improve their credit score because there's 5 different areas that you have to focus on. So for these reasons, I'm hoping that this video will shed some light on the elusive credit score, but also why it's so important to maintain a great credit score throughout your life and some of the best techniques to improve your credit score if you have bad credit. So if you guys do enjoy the video or gain any value whatsoever, be sure to smash the like button for me and do subscribe if you haven't already. So with that said, let's jump into the 5 proven ways to improve your credit score right now. Alright guys, so the first thing that you need to know is that your credit score is broken down into 5 different areas. These being your payment history, your credit utilization, the length of your credit history, your credit inquiries, and finally the types of credit that you actually own. So as you can see from your FICO score breakdown, the number 1 factor contributing to your credit score is your payment history. This has a very heavy weight on your credit score, being 35%, so it's definitely important to nail this one down. Now, this is the factor that's probably quite obvious to most of you and the one that you're most familiar with, so I won't discuss it in too much detail, but there are a few things that you do need to know. So essentially all this is that you have to pay off your credit balance at the end of each and every month by the due date, and then your credit score will increase. Now, in order to be able to do this effectively every single month, you need to make sure that you're only buying things that you can actually afford. If you're racking up a $1,000 bill on Amazon but only have $500 in the bank account, you're not going to be able to pay that off by the end of the month, and it's going to decrease your credit score. Now, along with this in mind, one trick that I do implement to be able to make sure that I'm making these payments every single month is to set up my credit cards on automatic deposit from my bank account. This way, I don't even have to deal with my credit card accounts, and I don't even have to think about it because the automatic withdrawal is going to pay for the credit card itself. And I make sure to have it set up to pay off the entire balance every single month, not just the minimum balance, so that I don't incur interest charges. And the beauty about this is that you never have to set up the automatic payment ever again in your life, and it's always going to make sure that you have a great payment history. Now, on the other hand, if you aren't so great with your spending habits and you do tend to spend more than you can afford, there is another option for you to be able to maintain your credit score. So I'm sure many of you have seen the minimum payment option on your credit card account. And the great news is, as long as you make this minimum payment of about $10, your credit score is not going to be negatively affected. In fact, it may actually increase over time as long as you have all of the other FICO factors in check. However, the bad news is that you're going to be paying interest on the remainder of your balance that you didn't pay off every single month, which is usually something insane like 20% interest. So this obviously isn't something that I would recommend because I never pay credit card interest. I always pay off my balances at the end of the month. But if you can't control your spending habits and want to build your credit score at the same time, this is definitely the option for you. Alright, so the second biggest factor contributing to your credit score is your credit utilization. Now, this is a factor that many people are not familiar with, yet it makes up a factor of 30% of your total credit score, and so it's very important to understand this. Your credit utilization is simply the amount of credit that you use based on the total amount of credit available on your combined accounts. So for example, if I had a total amount of credit of $10,000 across all of my credit card accounts, and every month I was spending about $5,000 of that credit, that would translate to a credit utilization of 50%, meaning that I spend 50% of the credit available. Now, the higher your credit utilization fraction goes, the worse your credit score is going to be. So even if you pay off your bills in full every single month, but you max out your credit card limits, You won't have a perfect credit score for this reason. So the recommended credit utilization percentage to stay below is about 30%, and that way you can still keep growing your score based on all of the other FICO factors. And one way to improve your credit score through this factor is actually by applying for a new credit card. This is because your total available amount of credit will be increasing with a new credit card, while if you keep spending the same amount, your credit utilization rate will go down. Now on the other hand, you can reduce your credit utilization by simply spending less on your credit cards every single month. Alternatively, you could spend money through your debit card or just paying with cash, and that way your credit utilization will stay low. But of course, over the long term, it is very important to keep using your credit cards as much as possible to be able to build your credit score and also get those sweet rewards. All right guys, moving on to the third most important factor in determining your credit score, and that is your length of credit history. Now this one is quite obvious. It's just the average length of your credit history, so pretty easy to understand, and it accounts for 15% of your total credit score. So for example, if you opened up your first credit card 2 years ago, and then you recently opened up another one, your average credit history would be 1 year. This is why it's very important to have multiple credit accounts and to start them while you're young so they can increase in length over time. Since the more accounts that you have will essentially dampen the effects of a new credit inquiry that you make in the future. So my best recommendations here are to simply open up multiple credit accounts while you're young and never close an account even if you don't use it. Now, as we'll learn in the next section, opening up multiple accounts can actually impact your credit score in the short term, but over the long term, this is going to be favorable in terms of your credit length history. Furthermore, by never closing a credit account, you're almost guaranteed that every single month your credit length history is going to increase, and that way you're going to increase your credit score. All right, so the fourth way that your credit score can be affected is by the number of credit inquiries on your account. This only accounts for 10% of your total credit score, but it is still significant, and I've noticed that it's affected my credit score on a short-term basis. So whenever you apply for new credit, whether it be a credit card, a mortgage, or a car loan, the bank is always going to ask you to have a hard inquiry on your account, and this affects your credit score in the short term. But ironically, the only way to increase your credit score in the long term is to actually damage your credit score in the short term by applying for more credit. So this one really isn't that important compared to all of the other factors, because really it's only a short-term thing, and your credit score will repair itself in about 6 months after an inquiry. But I would be very careful about applying for new credit in the short term if you do have a new loan that you're going to be applying for in the future, or even a mortgage, because you need to get the best interest rate possible with the highest credit score. So if you do want to keep your credit score healthy before you apply for a loan, just don't apply for any new credit cards or any type of credit about 6 months before the loan. That way your credit score is going to be very healthy and you'll be able to get the best interest rate on your loan. All right guys, so the fifth and final aspect that affects your credit score is actually the types of credit that you own. As I've mentioned in this video, there's many different types of credit that you can have, and not just credit cards. These can include a property mortgage, installment loans like car loans, or even lines of credit. And it should be noted that all of these different types of credit can affect your score, and it's good to have a variety. So in order to improve this area of your credit score, you're essentially going to want to diversify your credit portfolio, as funny as it sounds. But honestly, this really isn't the most important factor in determining your credit score because it's only worth about 10%. For myself, I personally only have one form of credit right now, being credit cards, and I've been able to maintain a credit score of about 785 over the past few months, which is considered very good. So obviously you can still have a great score even if you don't diversify your credit. If you can diversify your credit mix, it certainly would be ideal, but definitely not necessary. As long as you do well in all of the other areas that I mentioned for the FICO factors, you'll be totally fine just having credit cards, and you'll be able to build a great credit score. So in summary, your credit score is made up of 5 differently weighted components. These being your payment history, your credit utilization, the length of your payment history, your credit inquiries, and then the types of credit that you have on your account. And the best way to improve your credit score is simply by focusing on the big ticket items, being your payment history and your credit utilization first of all. But overall, to maintain a great credit score in the long term, you're going to want to focus on all of these 5 different areas and the tips that I discussed in this video. So if you are interested in learning more about the subject, just check out the link that I have in the description, and that's what I used to make this video. Anyways, I hope you found this video entertaining and actually gathered some value on why your credit score is so important, but also the many different ways that you can improve it. So if you did enjoy or gain value from this video whatsoever, just be sure to smash the like button for me. That really helps out my channel. And if you haven't already, you'll definitely want to subscribe for more content on personal finance, business, and investing in the future. Until next time.